Okay. Hi, welcome. I'm Gianna Short. I work at USDA, and I'm presenting work that I've co-authored with Bruce Aronson, who is on there to present, but he's letting me present today. And my boss, Charles Dodson at USDA. And then we worked with a master's student that Bruce was working with, Cecile Dowden. And yeah, so this is loan survival. Are socially disadvantaged farmers more likely to default? So I work in not exactly FSA, but I work with FSA loan data a lot. So that's where we're going to work. So just first, defining socially disadvantaged farmers and ranchers. The general, it's in statute somewhere, but groups that have been subjected to racial or ethnic prejudice, such as discrimination. So people who identify as Black, African American, American Indian or Alaska Native, Hispanic or Latino, Asian or Pacific Islander. And the definition may also include women sometimes, depending on the programs of USDA. We are going to look at women in this project. And then just the graph, a brief little breakout of producers by ethnicity and race based on ag census data. So in the footnote there, 95% of the producers were white. And about a third were women in terms of the primary producer for a farm. And so we have fairly low percentages here for all the different SDFR groups. Okay, so the data come from FSA. We're looking at direct operating loans with 7-year terms. And we look at all those loans obligated between 2011 and 2020. And we do stop tracking the loan servicing data in April of 2021 because we don't want to pick up any effects of the American Rescue Plan debt relief because that went into effect, but then it stopped being in effect. And so a lot of farmers might have stopped paying because that was sort of okay. Because so we didn't want that to mess up the data. So that we had 69,331 loans. But that was for 46,474 borrowers. So many borrowers got multiple DOL loans over this time frame. So we did a Poisson sampling in order to not overweight those producers who had multiple loans. And then we looked at 4 different outcomes, sort of, but 2 are kind of the same. So we looked if they paid in full, and the earlier loans, like the 2011, those earlier years, the 7 years would have finished in the sample. Some were censored. So like loans that are in 2020, we're not quite done. So that we're using a survival model. So censoring gets accounted for there. But that's fine in terms of working on the model. I see there's a thing in the chat, but I'm just going to keep going and look at it later. And then the thing we're focusing on is delinquency. So we looked at 90 days or more delinquent. And then, so that's if they're delinquent. And long-term delinquent is if, they hit 90 days delinquent, but then 6 months later, they still hadn't paid. And that's not a separate outcome variable in the model. We just look at the loans because it's a little interesting for descriptive statistics. So the final sample is about 46,000 loans of that period. Okay, this is a lot of charts on there, but on the left is farm type for all DOL borrowers, non-Hispanic white men, women, Hispanic, Black, American Indian, Asian, Pacific Islander. You don't have to look too in depth, but you can see there is some variation in the types of farms. That's sort of, it's neat to look at it, but you can still get a picture of some differences based on that. And then the graph on the right is breaking out those 4 outcomes. So the orange on the bottom is delinquent, the red is long-term delinquent, green is paid in full, and then censored is the gray on top. So the thing that kind of jumps out is that for Hispanic and Black borrowers, we're seeing higher rates of delinquency, particularly in that long-term delinquent category. Okay, so there's a lot on here. I'm just going to go through. We're using Cox competing risks model out of the public health literature, looking at survival. It's all on here. I'm just going to keep going. Okay, so when you're doing this type of survival model, you can get these charts that sort of show the probability of the outcomes over time. This breaks it out for all the different groups. There's a lot on here, so I'm not going to drive too much in there. But again, you'll see reflected sort of the things we were seeing before, like the purple, that long-term delinquent. We are seeing it go up faster, like in the black box up there, similar for Hispanic. So, okay, the results, we've sort of been queuing it up. So we tried to control for lots of factors, young or beginning farmer, married, whether they're solvent, low solvency, the debt coverage ratio, discretionary income, if they had point of sale balances like non-traditional lender credit, size of farm, and farm types. We tried to control for everything. If the red ones are significant, and if the number, the exponentiated coefficient, if it's above 1, that means greater likelihood of delinquency / sooner. So kind of what we're queuing up, women tiny bit more likely, Hispanic and Black, probability of delinquency increases, same for American Indian. Younger beginning farmers is actually less delinquent, and that we've seen that over and over. That's kind of something USDA borrowers are not, it's a different subset of borrowers. Okay, so I gotta keep going. So but we got to the results in time. Norbert Wilson's talk yesterday was, I think it was wonderful. And moving this work forward, so delinquency is not in control of USDA. It's on the borrower. So the results here don't reflect any potential current discrimination from USDA. But given all the historical context, you know, it very likely could reflect, the results we're seeing could reflect accumulated historical discrimination leading to less land, less capital. And so sort of my question for discussion is, how can we incorporate controls for that, right? And like, I don't know if we have an answer for it, but I think we need to start thinking about it. And if anyone has any ideas, I think that would be a really good place to start. Questions?
Yeah, I think in the control variable, maybe you can have something on the bank relationship, like how many times per year the farmer meets with the bank officer and that kind of thing, to see the trust and the level of relationship they have with the bank officer. And in that way, maybe it can make sense that if you are from a background which makes you less trusty of the bank institution, maybe you don't develop a relationship like when you have from the same family, from the same community, from the same church with the bank officer.
Yeah, so that's a really good. I'm trying to, in my mind, I'm like, okay, how can I measure that? Like, do we have that in our data? So it might. Yeah, that's a good idea. Yeah. Thank you.
These are direct USDA borrowers. They aren't, they aren't people who have guaranteed loans with commercial banks, but I'm wondering if
they might have guaranteed loans. Yeah. Yes. Yes. We do. We've done a little bit of that, and it's actually a little confusing because reliably we're finding if we put like a binary in here for are they a guaranteed borrower also, that actually increases their risk of default. And Charles thinks that's kind of picking up size effects, because it's like larger farms tend to be able to get guaranteed loans, and the larger farms also come with more risk. So it like, we can put in here, it's just often confusing to interpret because you would think, oh, people who have guaranteed loans can, be better. Oh, sorry. Okay.
And with that, we have also put in where we can see if they also have a farm credit system or from a bank.
Regardless of whether it's guaranteed.
Yeah, right.
Mhm.
And that tends to lower less it's a fee. Farm credit tends to lower the like.
Okay. I think my time is up. Sorry, we can talk more if you have questions afterwards. So thank you, everyone. Oop, okay.
Continue to share or something? Can you continue to share that? Something, yeah. So you can open yours and share it, yeah, or share desktop. I think that will be helpful. Yeah. I don't know. Someone said they left a comment. No, there's no comment. So you have 7 minutes. Yeah.
Thank you.
Morning, everyone. So I'm Jinhee Tong, a second year PhD student from the Department of Economics at Iowa State University. And my co-author is Dr. Sheldon Du from the Department of Agriculture and Applied Economics at UW-Madison. And today I'm gonna talk about the safety net programs and dairy farm bankruptcy in Wisconsin. This is on. And the U.S. Dairy industry has been suffering a lot of pressure in recent years, especially for the Wisconsin, so which has the highest number of Chapter 12 bankruptcy filings over the recent decade. And we draw this picture to see a downward trend of the number of total herds in Wisconsin since 2010, and also a rise in the bankruptcy rate since 2015. And to protect the farmers, and Farm Bill provides some risk management tools. One of them is the livestock gross margin for dairy program started in 2008, and which is to indemnify losses of gross margin. And the other one is the Dairy Revenue Protection Program, more recently in 2019, and which is to indemnify the declines in milk sales revenues. So studying the effect of these dairy insurance on the dairy farm bankruptcy is timely for farm survival and crucial for better policy design in this tough economic time. So we use a problem model to estimate the effect of the insurance demand on the bankruptcy probability. So the response variable is binary and equals 1 if the county has at least one bankruptcy case. And our key explanatory variable is the demand intensity for insurance, calculated as the viability over the cover production. And we control the cows per acre and farmers' average age in each county and year. And we also include state level profit margin as a year control and a county fixed effect. So to deal with the endogeneity of the potential endogeneity of the demand intensity, because there can be some confounding factors in the error terms. So we allow the error term, the structural error term here to be correlate to jointly distribute with the demand intensity here. And then we can make inferences based on the parameters here to base this by maximizing this joint distribution. And so the C is the coupler function here to bind the bivariate distributions to one-dimensional margin distribution, and these two are marginal CDFs for Y and demand intensity. And theta is a correlation is a correlation coefficient measuring the dependence between the two variables. So we have 308 bankruptcy cases over the 11 years, and also the contract specific insurance data for the two programs. So The LGM data spans all 11 years, and the DRP data only has 2 years. So the results here show a positive effect of the DRP program on the probability of bankruptcy, which is kind of surprising. And also there is no significant effect of the LGM program. And the results are almost same after we use the Kaplan method. So one possible explanation we have for this positive coefficient of the DRP program is that it is the reverse causality. So which means that farmers with higher bankruptcy risk may be more likely to participate in the DRP program. So we need to test the adverse selection. So here, following this classic GPE paper, which uses a bivariate problem model to see the correlation between the insurance purchase and accident occurrence, we can provide the evidence of adverse selection by observing a positive correlation. So here, instead of a bivariate problem model, here we have a bivariate mixed model here, and the coupler showed a significantly positive correlation for DRP program and a negative correlation for the LGM program, which confirms the existence of the adverse selection for DRP. And also we use another, another method to test the adverse selection. So this method can avoid the results to be confounded by the potential moral hazard. And this paper shows that the positive slope of the marginal cost curve of the insurance supply can prove that the existence of the adverse selection. And by combining the demand and average cost estimation equations, we can have the marginal cost curve here. And the sign of this sigma can tell us if the adverse selection exists. So our results show the adverse selection exists for both programs. So it is kind of inconsistent with the result before. So the main limitation of our research is the small data, kind of like the short time length. So the 11-year data set may cause the potential incidental parameter problem in the fixed effect problem model. And also the 2-year of DRP data can cause the dynamic panel bias due to the limited number of legs. And also the inconsistent results for the LGM program needs to be further explored. And since we have the contract level of the insurance data, we can do a simulation for the insurance programs to see the difference between the margin protection and revenue protection programs. Yeah. So these are the appendix of some descriptive statistics. And this is the model selection for the problem. This is the average selection. Thank you. Is there any question? Yes.
So your typical bankruptcy data was at the county level.
Yeah.
Did you examine the individual filings to see if they were dairy farm bankruptcy?
Yeah, they are all dairy farms.
So just dairy, okay.
Yeah, because the data comes from so the data comes from the PACER. So this one we can check the individual profile of the bankruptcy farm. Yeah.
That's great. I haven't seen many studies that look at the individual filing.
Yeah.
I'd like to understand a little bit more.
Okay. Oh, thank you.
So you were just
sorry.
trying to explain if there was one bankruptcy or more per county.
Yeah.
Right? And then you looked at
Actually, so here we the binary variable is one if the county has at least one bankruptcy case. So actually there are more cases in some counties.
right.
We also do a count model to explain the the more like positive integers, but the results are not.
So is it the cows
Mhm.
per acre and farmers' average age for those that declared bankruptcy or just for the?
It's just county level.
So wait, I think you're just finding where there's more cows,
Mhm.
more intensive and older age, they're more likely to be at least one child. So it's more of an intensity, I think, of the
Okay.
county's dairy production.
Okay. Yeah, that's a good point. Thank you. Yeah.
Do you have MVP participation or DMC participation in there
Yes. So this is
in
the
your model?
not in my model because I don't have the specific data for those two programs. These two programs are from the FSA, I think,
Yeah,
and the two programs I'm studying is from the RMA. So
I think the farms that are going bankrupt are the smaller ones.
yeah,
And they don't use,
yeah,
they're gonna be using the FFA program. So it'd be interesting to see it not participating in the FSA program.
yeah, that would be better if I can get the data.
That would be-
Yeah, thank you very much. Okay. Thank you.
These ones, yeah. Yeah.
Well, thank you all for coming to this presentation, which we titled The Supply and Demand of Agricultural Loans. This is a joint work between me, Francisco, Todd Q from Purdue University, Ty Craitman from the Kansas City Fed, and David Opedal from the Chicago Fed, and the usual disclaimer applies. Despite the centrality of credit to farm sector, the literature has suggested that farmers can be credit constrained. And if this is true, credit constraint can be quite severe for agriculture. And the reasons that, there is big lags between buying inputs and selling outputs in farm activity. Farm capital can be quite inflexible. Basically, farmers only have farmland as collateral. Farm operations are quite small in relation to other parts of the economy, right? Businesses in other parts of the economy. And farmers have limited access to other forms of debt capital, which means that they rely a lot on credit loans. And if this is true, we know that loan rates fail to equate supply and demand because of adverse selection and moral hazard issues, which implies that we have periods of excess supply in ag credit and excess demand in ag credit during the business cycle of agriculture, right? So what we want to do here is measure the changes, the impact that changes in demand have on the volume of agricultural credit, and the impact that changes in supply have in the volume of agricultural credit, right? So the way that we're going to do this is we construct this bank-specific panel of non-real estate ag loans at commercial banks and market conditions, right? So the measures of changes in demand and changes in supply are coming from 20 plus years of survey data from several regional Federal Reserve banks. We merge those with administrative data, FDIC core reports to get a sense of how how changes in volume of credits are happening, okay? Again, the idea here is pretty simple, is to disentangle the effect that supply has on the agricultural loans from the effect that demand has on agricultural loans, right? And what we find is that demand shifts the volume of agricultural loans more than supply, okay? And sort of like as a corollary, you also find that demand for credit seems to be counter-cyclical to farm income, okay? So here's a little bit of the intuition of what we are doing. If we are pretty sure that we face and we experienced a shift in demand and we are absolutely sure that supply is held constant, it's quite easy to build a model to try to quantify the shift in demand on quantities, right? Same thing with supply. If we know that supply has shifted and we are pretty sure that demand has not shifted, pretty easy to build a model that quantifies the shift in supply on quantities. The problem is that when we have a shift in demand and supply, we have three things, right? We have the shift in supply, we have the shift in supply, the shift in demand and the co-movement between supply and demand, right? Which means that we have to quantify this co-movement and try to incorporate this into our econometric specification, right? So how do we do that? We employ what I'm calling a plug-in approach. It's based on Bassett et al. To try to capture this co-movement between supply and demand, right? And what we do specifically is at a first stage, we regress bank-specific changes in demand on bank-specific changes in supply, control from several bank-specific characteristics plus macroeconomic conditions. And what we obtain from this regression is this residual here, right? This little V over there. And what this captures are the changes in demand that are not explained by changes in supply, right? We do the same thing with changes in supply. We have bank-specific changes in supply, regress then on bank-specific changes in demand. Let me take this out of the way. We regress bank-specific changes in supply on bank-specific changes in demand, same set of controls, and the residual of this regression are the changes in supply that are not explained by changes in demand, right? We take these residuals and we plug them into a second stage regression in which we have the changes in the volume of agricultural loans on the left-hand side and the sphere measures of supply and demand here. So what we're interested are the coefficients omega-1 and omega-2, right? So basically capturing the sphere impact of supply and demand changes in agricultural loans. What we find? Well, we find that changes in demand moves total agricultural loans much more than changes in supply. And you can see that in this table over here, right? The first line are the coefficients related to the residual change in demand. You can see that they are quite large and statistically significant. And the residual change in supply, the coefficients are much smaller and not statistically significant, right? So yeah, we learned that, changes in demand, they matter quite a bit for changes in the volume of agricultural loans. These results are robust to a series of checks, right? Several other definitions of supply, other leg structures, subsamples, dynamic panel structures, you name it, we have tried it, and results are pretty robust. Another thing that we do in this paper is we came up with this measure of how strong demand is across time. This is the black line, right, in this chart over here. And whenever the black line is above 0, these are periods where demand is strong, right? If we plot this measure against changes in farm income, you're going to see this, counter-cyclical sort of like pattern, right? We test this counter-cyclicality using this Hardin and Pagan tests, and we basically find that, yes, they are periods of strong demand are counter-cyclical to periods where farm income is down, right? Which is very suggestive that farmers use loans at commercial banks as a way to smooth consumption and investments, right? So basically what we learned from this paper is that demand is quite important for the growth of ag loans at commercial banks, much more than supply. Periods of strong demand can increase the growth rate of loans. Demand for loans runs countercyclically to farm income, and one way to rationalize this is that farmers use credit to smooth consumption and investments, okay? There's a lot to this paper, a lot more results. This is a working paper that you can download from the Kansas City Fed website, and I'm happy to talk to those who have questions.
So the fact that demand is driving ag loans, is that consistent with this idea that farms are severely credit constrained? Is that consistent, or how are we kind of reconciling?
It is not consistent, right? It would be credit constrained if supply was impacting, adverse impacts. I mean, tighter conditions in the supply of loans would be impacting the volume of agricultural loans more. So basically, it would be like we would have a cyclicality between, downturns in the economy, banks not offering as much credit, farmers really need credit and they cannot get. We find exactly the opposite, right? The demand for loans is what's driving the changes in volume of agricultural loans.
Yeah, so I was going to ask,
in the motivation, you use that severe credit constraint as motivation. Where is that coming from? Because if you look at, Windong's Iowa survey, like 80% don't even have a loan on their land. The USDA ERS data, the debt to asset ratio, it's on its way up. It's still like 15%.
Yeah.
Like that's not consistent. And the research I've done, and I know Jimmy's done,
Yeah, for both anecdotal evidences that we see a lot from farmers and also from a really old literature in the 60s, 70s, and 80s, which claim that. And I mean, this hypothesis was never tested, right?
Yeah.
So basically, from this, yeah.
You're not really looking at the micro data though, right? So
It's bank-specific data. Bank-specific data.
Yeah, but there's maybe 2 out of 50 farmers that are maybe credit constrained, but the other 48 are increasing their non-real estate.
Right. I mean, we can find some Yeah. I think I see the point. I mean, yeah, we can have some heterogeneity. I'm not saying that we don't have farmers that are credit constrained. On average, given, these measures of changes in demand that are very bank specific, right? And supply, we don't find any evidence on average that banks are withholding loans from farmers. Jane?
Substitution between types of credit.
So going from to the FCS instead of going to commercial banks, or yeah, okay, perfect. Good.
Hello, my name is Diraj and I'm from BTech. So this is actually my master's thesis, which I did back in UGA. My major was Professor Sesser and co-chaired by Will Strecker. So the study is about sustainable growth model of US banks during the COVID period. As we all know that something unexpected happened at the end of 2019 and the 2020 was a devastating year because of COVID. So the banks struggled during the 2020 because the income fell for bank failures. So the research question is how banks spend their resources during the COVID period. Did they spend their resources for aggressive growth challenge, or did they adopted some cost assistance to cope with the stressful financial environment during the COVID? And also because the agriculture banking sector, it has been viewed as a negative perspective. So the study also focuses on the bank types by agricultural loans here. Any bank with higher than 25% agricultural loans here as ag bank, and the rest as non-ag banks. The model revolves around sustainable growth rate, which is actually the maximum growth rate at which a firm can increase its revenue without depletion of resources. And the 4 pillars of growth, profit margin, asset turnover, earning retention, and the financial leverage. So we calculated SGR, which is the product of the 4 variables. And then comes the sustainable growth challenge, which is nothing but the difference between the actual growth rate and the sustainable growth rate. And if the SGC, or sustainable growth challenge, is positive, it means the firm is growing aggressively. And if it's negative, it means the firm has not realized its full potential, or we can say it's growing sluggishly. The data comes from the FFIC website, which is the call report database. It consists of the quarterly financial reports for the year 19 and the year 2020, which is the COVID year. And we used seemingly unrelated regression SURE model because the data was had contemporaneous cross-section error correlation. The Bruce-Pagan test justifies that this model is suitable for the regression. So we regressed for these different variables of the growth rate growth model against those different variables, SGC, HSI with the loan diversification index, and then liquidity, bank size, AG, and COVID. These two, they were the dummy variables. So the results shows that the agricultural banks, they had high profit margin as compared to non-ag banks. And overall, during the COVID period, the profit margin fell by 1.9 percentage points. So next equation is the earning retention equation. So the earning retention was not different between the two bank types, and also between the two periods, the earning retention was not different. And we also regressed the data just for comparison for pre-COVID and the COVID period separately, and then for the overall data set. The next equation is the asset turnover equation. We can see that the asset turnover for ag bank was higher as compared to non-ag banks, and the asset turnover fell during the COVID period. And this could be because during the COVID, despite other businesses, they were affected by COVID, but agriculture was not that much affected. So could be because of that, the asset turnover for the ag banks was higher. The next equation is the leverage. So this implies the capital seeking tendency of the banks. So we can see the capital seeking tendency is similar to the non-ag banks, and also the capital seeking tendency during the COVID was higher. This is kind of counterintuitive, but it's because during the COVID, the deposits rised, they increased. So the result is counterintuitive or unexpected. The final equation is the sustainable growth challenge equation. We can see that this growth was higher in case of ag banks, and also the growth was decreased during the COVID period for all the banks. The key takeaways are that US banks adopted a cautious stance to overcome the COVID crisis, which is suggested by the lowered growth during the COVID period. And the next one is the agricultural financial sector is more resilient to the economic shock of COVID as compared to the non-ag banks. Thank you. Any questions?
I remember reading a paper that's very closely similar to the study by Dr. Escalante and on AFR. I think it was on the sustainable growth challenge under the economic recession pressure, something like that. Are your findings different from this paper findings? Do you know?
Yeah, actually, this sustainable growth model is more common in the corporate finance sector. And this study was first done by Professor Escalante in the ag finance sector. And the difference is, I have added the variable COVID because I just wanted to investigate what happened during the COVID crisis. And another difference is I added some of the bank structural variables like liquidity and bank size for the study. Any other questions? Thank you.
Good morning, everyone. My name is Peng Hui, and same as your committee, we have Dr. Zico and Dr. Escalante. Yeah, today I'm going to talk about banking efficiency analysis for U.S. agricultural and non-agricultural banks comparative period analysis between the Great Recession in the late 2000s and the current pandemic conditions. So in the last 2 decades, the U.S. economy had to deal with 2 significant economic downturns. We know that the both have significant impact on U.S. banking areas. In this study, we will mainly study how the efficiency for U.S. agricultural and non-agricultural banks can be impacted differently by the 2 different crises. In terms of methodology, we adopt a 2-step stochastic frontier approach using the SFA to measure bank cost efficiency in the first step, and the dynamic parent data GMM approach in the second step. Here's a little review. Since the time constraint, I will just skip this part. So in terms of the methodology, in the first stage, we use the SFA method. In the SFA analysis, we have 2 efficiency. One is called cost efficiency, and another is called the profit efficiency. In this study, we only use the cost efficiency because it receives the most attention in the U.S. banking area. And here, the CIT is a cost for bank, total cost for bank, and F is a production function, and VIT is a normal ID random error with 0 means and variance sigma v square. And UIT measures the cost inefficiency and allows the positive half normal distributions. For the specification of the SFA model, here we use a more flexible translog cost function. And since the because the specification produces a better feature of frontier than the Euro Cobb-Douglas function. Here, C is the total cost for bank, and Y is the output for bank, and P is the input price for bank, and here the T is the time chain. In doing the stochastic frontier analysis, we need to meet 2 restrictions. The first one is the symmetric restrictions, which requires that the beta y ymk equals to beta ykm and beta plr equals to beta pln. And we still need to meet the homogeneous of degree 1 in the input prices. That is the sum of beta pn equals to 1, and the sum of pnr equals to 0, and the sum of beta y pmn equals to 0. And after imposing these restrictions, we get the following estimating formats. And here the cost efficiency for a bank is defined as EFFI, which equals to 1 divided by EXPU. The range is from 0 to 1. 0 means 0 efficiency, and 1 means 100% efficiency. So in the second step, we following criteria, we use the GMM dynamic parent data model. In the second step, here the EFF is the cost efficiency levels from the first step, and the EFF I T-1 is a 1-year lag of bank as cost efficiency, and time minus G. And beta B is a vector of bank specific variables, and macro representing some macroeconomic variables. And the COVID is a dummy variable for the COVID-19, and the crisis is a dummy variable for the 2008 financial crisis. When defining the outputs and inputs for a bank, there are several different approaches in the current literature. In this study, we use the intimidation approach as suggested by the Berger and Humphrey. In this study, the outputs include total agricultural loans, non-agricultural real estate loans, and other non-agricultural loans, total investment and non-interest income. And the input price consists of price of physical capital, which is calculated as the occupancy expense divided by premise and fixed effects. And, and we also have the price of borrowed funds, which is the ratio of total interest expense to the sum of deposit and other interest-bearing funds. Finally, we also have the price of labor, measured as the average personnel expense per employee. In this data, we use both banking level and macroeconomy data from 2004 to 2020. The final data sample is the parent data with 450 agricultural banks and around 3,000 non-agricultural banks, with a total number of 58,000 annual observations. Here's a descriptive of sleep. Now let's go to the results. So in the first step, we use the SFA, and this results suggest that our SFA model fits well in our data. And the first stage results show that on average, agricultural banks are less efficient than non-agricultural banks, with average cost level 85% and 86% respectively. However, we also find that the cost efficiency of agricultural banks are higher than non-agricultural banks during the period of 2012 to 2014. Now let's go to the second stage results. From the table, we can see that all requirements are met for the GMM model, and our results indicated that 2008 financial crisis have different impacts of agricultural banks and non-agricultural banks. You can see in the financial crisis have significant and negative impact on the non-agricultural banks. However, it has no significant impact on agricultural banks. And our results also show that COVID-19 actually increased the cost efficiency levels of both types of banks. As a conclusion, our results show that both US agricultural and non-agricultural banks are less than fully efficient. Non-agricultural banks are more efficient than agricultural banks, with average cost efficiency levels of 86 and 85% respectively. And the second stage results suggest that log asset management, bank income structure, and all the macro environmental variables are significant and the same directional impacts on cost efficiency levels of US agricultural banks and non-agricultural banks. Our finding also suggests that 2008 financial crisis have different impacts on both type of banks, and the COVID-19 pandemic actually increased the cost efficiency levels of both type of banks. So thank you. Any questions?
So the banking sector at the Kansas City Fed has several studies showing that ag banks are quite efficient. Have been squeezed in terms of news for quite some time, and they had to be. So I'm trying to square this type of results with what you find in terms of your stochastic analysis and efficiency analysis, and I'm having some difficulty to.
Oh, I see. So that's a good question. So actually, I have another paper use the DA function. I also find the same results that agricultural banks is more efficient, but that depends on the input and outputs you choose for the bank. So in this way, so here, so actually, so I saw a lot of papers also use the intermediation approach in defining the output and input. However, some of them did not include the non-interest income. So actually for the traditional intermediation approach, the output will only include the agricultural loans, non-agricultural loans, or other loans and total investment. But actually, so non-interest income is also a very important part for a bank. So that's why in this study we also include this one. So that's why the results may seem different. Yeah.
Your samples of ag and non-ag banks.
Yes.
You might have probably missed it, but did you match those somehow, or did you just take all ag and non-ag?
That's a good question. Yeah. Sorry. So actually, I took all the agricultural banks, but for the non-agricultural banks, I will just include the banks with more with asset more than 10 billion. Yeah. 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 That makes the stats more comparable. Yes. Any questions? Thank you.
Okay, good morning. My name is Kevin Kim from Mississippi State University. The paper that I'm going to present today is titled Determinants of Community Bank Consolidations, a relevant study co-authored with Dr. Anika Choba. And I want to thank Courtney first because this paper really started from the conversation that you had with Dr. Anika Choba, I think 2 or 3 years ago, why agricultural banks were consolidating and so on. So this paper was motivated from the conversation. So thank you for that. So brief background of this paper. We had an ongoing discussion about the rapidly declining number of banking institutions in the United States. So if you look at the time period between 2012 and 2018, we saw a 22% decrease in the number of banking institutions. Now, if you look deeper into the bank characteristics, most of the decrease was triggered by the consolidation activities occurring among or targeting community banks or banks that have asset size less than $1 billion or have limited multi-state presence. So it was the consolidation activities in the community banks. And from the literature, we had a series of studies showing that these community banks are the backbone of the local economic growth, and they act sometimes pretty differently from the national banks. So these are very important institutions. So in the literature now, we do have some studies that examine the implication of community bank or agricultural bank consolidations. But the missing component is really on the other side, studies that try to identify what's triggering these consolidation activities. Now, we can, of course, look at the finance literature because mergers and acquisitions is a big topic for the finance. But if you look at the studies conducted in those stream of studies, usually first studies will focus on large national banks, only the ones that are traded on public. And second, what you find is that there will be 2 different streams of studies mainly. The first stream of study will examine the probability of a bank acquiring some other bank at some point in time. The other stream of study will focus on a bank getting acquired by some other bank at some point in time. Now, that was attacked a lot by the researchers in the strategic management literature. They also spend a lot of time on mergers and acquisitions or consolidations, and they argue that when you think about consolidation activity, you are talking about managers analyzing not only the isolated characteristics of the acquirer or the target, but it's also the relative differences that matter between those two. So they stress that it is important to address acquirer, target, relative differences at the same time in the single equation. So there's been a very interesting developments in terms of methodology, how to conduct that sort of research. And that's where we borrow some of the ideas to test to find out what are the determinants of community bank consolidations. So research goal, again, identify the factors with specific focus on whether it's the geographic diversification or the loan portfolio diversification that's motivating the the community bank consolidations. Also, some other specific focus on whether it's the better performing national banks acquiring relatively poorly performing community banks. And also we asked whether the large national banks are acquiring community banks to possibly achieve too big to fail status. So we try to do it while examining the acquired target characteristics at the same time, as well as the relative differences, while overcoming some of the major issues that were prevalent in the literature. which I'll be happy to discuss after the presentation. So our research was based on the core reports, but we reconstructed the data following the recent methodological developments developed in the strategic management literature. So assume that there are 3 potential acquire and 3 potential target. Then we are talking about 9 different potential consolidation activity scenarios, out of which only a few of those will be actually flagged as an actual event occurrence. Okay, so what we did for this paper was that we considered national banks as the population of national banks as the potential acquirers and the population of community banks as the potential target. Using the pairwise combinations, we created all possible mergers and acquisition scenarios, which resulted in a more than 13 million possible cases, out of which only 300 of those were flagged as an actual event. Now, this sort of study is considered to be a rare event study, and the literature finds that running a traditional logistic regression tends to result in a biased estimate. So to overcome that, we also did some robustness tests beyond simple logistic estimation, including the rare event logistic estimation and force logic estimation at the end. So here are the set of variables that we looked at. So on the left-hand side, we have individual bank characteristics for both the potential acquirer and the target. So we had size, some performance measures, and the capital structure, local competition, loan portfolio diversification or concentration. And the left-hand side, we have some relative measures that try to test for the motive for portfolio diversification, geographic diversification, capability deployment, and concentration, among other things. So here are the main results. Long story short, some interesting findings, I would say. So from the acquirer perspective, what we documented was that performance measures of the acquirer really didn't matter in predicting the probability of community bank consolidation occurring. And what we find was that better capitalized national banks were less likely to acquire. However, for the target's perspective, larger size community banks were more likely to be targeted for a consolidation, which we saw as a sort of an evidence of the goal of achieving too big to fail status. So that was a one big thing. Poorly performing community banks were more likely to be acquired, but not necessarily their capital structure. Very interesting finding in the relative measures. We've documented that geographic diversification was a big motive for acquiring a community bank, but not the portfolio diversification, which was pretty interesting to us. We actually ran an additional test where we put an agricultural bank indicator variable, and actually that one had a negative and significant coefficient. So national banks were less likely to acquire an agricultural community bank. So that was a very interesting finding. And also we document that relatively better performing national banks were more likely to acquire relatively worse performing community banks beyond their isolated characteristics. So these were some of the major findings. I think I reached my time. Okay, so too big to fail status plays role. We really want to think about the implication of this geographic diversification through a consolidation of community bank, because now number of community banks decreased from 6,500 to now, I think less than 5,000. And if this trend continues, we are likely to see a very small number of community banks in upcoming years. So yeah, I think I reached my time. I'm sorry for beyond 7 minutes.
Nice job, Kevin. This is really interesting. And it makes me kind of wish that we had data or unit data on like management characteristics of community banks. A lot of the anecdotes we hear from like larger banks, and this is in the ag space, that will talk about like smaller banks approaching them.
Yes.
Say, I'm getting close to retiring, and you know, like basically requesting an acquisition. But I think that would be really
that's the
I don't know that
that's the story that Anya told me, and that's what motivated this paper.
Okay.
Board characteristics or the manager characteristics. That I know the data is available from the business school, but I don't have the funding to afford it.
Or like Did you look at any like branch locations? Like,
So that's what we tried. We are working on the branch locations to see whether there was a branch overlap beyond headquarters. For the geographic diversification, we mainly looked at the headquarter level,
okay.
but we are reorganizing the data to incorporate the branch level overlap as well. Oh,
Maybe a very main question, but I wonder about, because of the innovation in information system in banking, maybe we have economies of scale that appear very discussed often.
yeah,
And
that's,
why economies of scale are not if it could be an assumption like too big to fail, instead of that, it could be economies of scale.
Mhm. Yeah, so economies of scale, I thought that was sort of addressed with the positive coefficient on the target community bank size, because this means that national banks are acquiring a larger community bank, yeah, compared to smaller community bank. So, yeah, Bruce.
Yeah, it was, I think looking at the branches, because that's kind of a real concern about
Yes.
losing that,
Mhm.
as long as there's
Yes.
still the branch
Mhm.
network.
Yeah. Mhm.
Or if you have less
Yeah.
competition if you lose
Yes.
multiple branches.
Mhm. Yes. Mhm.
I'm having a hard time thinking that there's a real motive for too big to fail. You might have to have a lot of acquisitions
Yes.
to get smaller banks to get to that size, where you can do it in one pretty good size bank to get over that threshold.
Yes, that's definitely true. So one thing that I'm thinking is to have an indicator variable for a national bank having an experience of acquiring community bank, like, you know, above certain threshold in the last few years. Yeah, that's certainly an issue that we can address. Thank you.
Can you just clarify the geographic diversification? It's not the geographic diversification of loans, it's the geographic diversification.
So
where
the
headquarters.
Headquarters are, yeah. So this sort of like, so what this one is really saying is that national, so I'm saying national banks, but we are talking about multi-state banks. And when I was looking at the data, there were very few multi-state banks that had branches more than like 15 states. So, so this is really what it's really saying is that they are not necessarily acquiring another community bank within their main state of operation. Yeah. So yeah, I need to be a little bit more cautious on that. Yeah. Thanks. Sorry.
Hello, everyone. Today I'll be walking you through a work in progress on farm loan concentration and financial risk. This is co-authored by Professor Ift and then Luke Byers. Now, multiple borrowing is a common feature that we have observed across a globe or across countries. And we have also seen the same in Kansas. So when we look at Kansas Farm Management Association, we realize that over the period 2002 to 2020, we see that majority of farms engage in multiple borrowing. They take loans from 2 or more lenders. Now, this provides opportunity for farms in the sense that now they can have access to more credit. And in case, let's say a lender fails in supplying credit, they can rely on other lenders in the market. But this provides or leads to some risk in the sense that now farms may be monitored. So instead of one lender monitoring a farm, you may have several banks or multiple lenders monitoring the same farm, and it could lead to over monitoring. Aside that, we have also seen that banks come together and also coordinate on loans or loan amounts to give out to farms, and there could be coordination failure in such instances. With the interconnectedness, or let's say because they take loans from these multiple lenders, we have some level of interconnectedness within the banks and also the farm as well. So a default may spread within the financial system. Because of this implication, we've seen earlier studies by Brewer and others in 2014. They look at the number of loans or the number of lenders and check whether farm characteristics are related to the number of lenders. And they have found pretty interesting results on farm characteristics and some other characters that may be driving this behavior. Now, looking at this, we realize that the intensity of loan that you might get from a lender may not be the same as the number of loans. You might take more loan from lender A compared to lender B. So we decided to look at this again, and we want to see to what extent do farm and market characteristics drive this multiple borrowing behavior? And also to what extent does financial stress affect this phenomenon? Now, so I would walk you through loan concentration a little bit. What I realize is that when you take, let's say, loan from 5 lenders, if you add the shares, is equal to 1. And to deal with that, we have relied on, or we used a Fiedel-Hitchman index by squaring the share of loan from these lenders. So when you square them up and you sum it up, you end up with an index which will tell you the level of concentration of loan from the number of people you have taken loan from, or the number of firms you have taken loan from. So when you have a 3-firm example, so firm A, let's say, takes loan from 1 lender, then it means that it is highly concentrated in the sense that it takes all its loan from 1 lender. And for firm B, taking it loan from 2 and also distributing it, let's say $100 from the first lender, $20 from the second lender, we see that it has a concentration index of 0.72, which is concentrated, but not as much as that of firm A. For firm C, when we have an equal distribution, we see that that is also less concentrated compared to the other 2 firms. Now, so here we see that the number of loans may not fully coincide with the loan concentration. So this we have graphically illustrated by plotting all the data, and we see number of loans may not necessarily be the loan concentration in the data set. Now, based on this, we want to see which market factors or which farm characteristics may drive a farm to fully or to highly concentrate its loan. We also look at a fixed effect model in which we look at, let's say, farm stress. In analyzing our data, we realize that temperature is negatively correlated with farm net income. So we try to use that in testing the relationship between temperature and loan concentration in a fixed effect model. So some other factors that we may look at, let's say the operator's age. We look at, let's say, the banks, the number of banks in a county, and some other market characteristics. Now, in the determinants model, we see that farm size is negatively correlated with loan concentration. So as a firm grows larger, the concentration of loan reduces or it declines. We also look at that of debt to asset ratio. There is a decline, but for banks per people in a county, we do not observe any relationship between them, or there's no association between loan concentration and the banks per people. For the financial stress model, I want to stress one more that because of the negative relationship between net farm income and temperature, we use that as our main covariate to see the relationship between temperature and loan concentration. Initially, without controls, we see that that will drive concentration. So farms that tend to experience extreme temperature may concentrate their loans in the sense that they may take loans from a fewer lenders and may take a larger share of their loan from fewer lenders. But as we control for other size and other size characteristics, let's say you look at the labor force, the head size, and total farm size in acres, we see that that association vanishes or is no longer there. and you include other controls as well, we see that that does not exist anymore. Yeah, so we also look at lender concentration. Aside the loan, we look at the lenders and see what would be the result as well. And we equally look at, let's say, the largest share from, let's say you look at 4 lenders, what is the largest share for these 4, and use that as the dependent variable and regress that on other independent variable. And we see the results are similar to what we have observed for the loan concentration. For the financial stress model, the same thing, we see similar results in the model. And for the probability of multiple borrowing, we see that there is what? A negative relationship between operator's age and the probability of borrowing, which largely confirms what Brewer and others found in their papers in 2014 and 2019. So in effect, we were thinking that this may be because of several stories, and one could be that these firms may be leveraging on their size to get more loan to aggressively expand, or it could be that there is some level of competition going on, and for that matter, in the credit market, and they are trying to get these farmers to sign up for more loans, or there could be other stories that we could also deal with. In the future, we want to see why, they may concentrate in a specific lender, maybe if it is farm credit, if it is the commercial banks, why this may be the case. And we are also open for suggestions as to how to improve this study. Thank you. And I'm in for questions. Yeah.
Do you see the timing of the loans? For any given farmer that has multiple loans, do you see like the amount and the timing that they have for each one of the loans?
Yeah, so we see the time, the year in which the loan was taken, and then and the amount. What do you mean? Like, you mean in terms of monthly or a daily? No, we don't see that. No. I don't see that. Yeah. Yes.
I saw you had herd size, so is it all cow-calf operations, or do you have diverse farm type?
Yes, so we are looking to control for other specializations, but here we briefly, or let's say preliminary control for the side for beef production. Yes, so we'll be looking for.
You have it as a continuous variable, but a whole lot of them are going to be zeros.
Yes, so what happened is we have the continuous variable in this one, but in other regressions, I look at categories, various categories, and the results are pretty consistent with what we have here. Yes, yes.
Did you do any interactions between like the age and the financial leverage or the return on assets? Because I think I saw, was it return on assets? Yeah, debt to asset ratio is negative, right? And the theory would tell you that as you increase that asset, you should probably spread out your risk, right? Because that's the holdup problem.
Yeah.
So I wonder what's any. To me,
Okay, so I haven't really considered the interaction terms.
Okay.
Yeah, I haven't really considered that, but I think I will consider. Yeah.
As you become more leverage, you become less concentration.
Yeah.
You're shaking.
Chicken.
You're shaking the trees. More trees for money.
So that's what,
Yeah.
Oh, okay.
Yeah. Yeah.
Then that's what you.
Yeah. Yeah.
But the return to asset, that's.
Yeah.
So if you become more profitable, less.
Yeah.
Yeah, because
You're not necessarily.
yeah, the optimal number of lenders is 1. If you know that lender will always lend you, you just won't want to.
Yeah. Okay.
I'm sorry.
I'm saying.
I was gonna ask, the type of loan matter. Because, we know that a lot of operating lending goes through, banks, but, and I see clients through the farm credit, but a lot of, like some of the farm equipment lending may be non-traditional sources, some of the land may be more through farm credit, so. It doesn't seem to be specified. I don't even know that it would be important, but
Yes, so yes, it's possible that it could be the case. We also ran a regression looking at the shares from these various lenders, let's say non-traditional sources, commercial banks. That I did not include, but we have some results from that as well. And yeah, some have some differences. Yes.
And maybe a little relay, I was looking at maybe share of leasing or something of operated acres, maybe somewhat related with that rate of return on assets.
Yeah, that was included as well. Yeah,
Leasing?
Yes,
no,
that-
leasing.
yeah.
Okay.
that was included.
One thing that we've seen too, I don't know if this captures participation on loans, so. One thing we saw, I haven't looked at the data recently, but prior to the pandemic, we were seeing like small banks doing a lot more participation.
Okay.
And, you know, at that time, loan demand was high, you know, farmers are like, kind of like your results show, you know, large farms may outgrow their local agriculture. So on the backside, you know, that's something we've seen in our data, that participation is going to tend to increase when loan demand is high.
Okay.
That's when lenders are working more.
Yeah.
Didn't depend on the
That's
backside.
okay. I guess okay. I guess that's all. Well, thank you for coming. Yeah, who knows? Yeah.